thank everybody for joining today. This is a webinar. I give webinars twice a month. When we get into January, I'll be giving webinars on the second and fourth Thursday of the month. The only thing I haven't decided if I'm going to continue to alternate between the 12:30 and the 5 o'clock time or just do them at 5. Today's webinar is, where will your retirement income come from? So first, let's talk about some common sources of anxiety as we approach retirement. You can see that I have listed here a number of them: rising inflation, healthcare costs, the stock market works against us, children moving back home, deciding when to take Social Security. If you take it at the wrong time, it can be costly. Who's going to take care of your finances, especially if there's only one spouse and the other one's been doing it? Having too much debt, because not having debt is a way to make retirement a little bit easier if you don't have to worry about those payments. And then I kind of saved the biggest one for last. Running out of money. That's something that I think a lot of people really worry about as retirement approaches, or in retirement too. And so there's two types of risk in general that I think about in retirement. And the first is sequence of returns risk. And what I mean by that is, when we know that the market's not going to go up every year, so there's going to be some bad years. When do those bad years happen? It's contrary to popular belief, but when you're still adding money to the market, I can make a really good argument that a falling market's your friend, because if you're adding money regularly and buying the same thing through your 401k, you buy more when the price falls. So that's to your benefit. For example, if you were buying something that costs $25 a share and you're putting $100 a month in, you got 4 shares. If that asset fell by 20%, so now it's $20, that same $100 buys you 5 shares. If it comes back to 25, now your $100 investment's worth 125, so that the original piece was still only worth 100, but you've made another $25, which is a 12.5% total return on that investment. When we're not adding money to the market, those down years are more painful because we can't take advantage of the downturn as easily. And then in addition to sequence of return, it's longevity risk. And longevity just refers to how long do we live? Because the longer we live, the longer we need our money to last. And we want to hopefully not have it run out before we pass. So when we work, we get paid a regular paycheck, right? So we're used to having money coming in all the time. When we retire, that stops. And it's also changing. We're moving from saving and building an asset base to spending and reducing our asset base. That means things become a lot harder. You have to monitor your investments, your spending, your tax bill. You're responsible for all those things. There's no regular withholdings coming from your pay either. I like to think of it, we try to create a retirement paycheck. And part of that involves addressing the things here. When do I take Social Security? If I have a pension, do I want to take a lump sum? Do I want to roll it over? Or do I want to just take the benefit that's offered to me? Should I consider an annuity? For some people that may make sense, for others it may not. The biggest thing you have to be careful about, if you do think about annuities, is they can be very expensive. And those costs hurt your returns. How do I allocate my investments? What makes sense? What are they going to provide to me in terms of income? And what is my retirement savings? So I mentioned the retirement paycheck, right? So there's different ways that we can get that. First, if we have that regular payment coming in from Social Security, pension, or annuities, that's part of it, right? We know that comes in every month. But also, you want to think about the total return that your retirement or any other assets that you have can give you. So when I talk about total return, I'm referring to interest, dividends, capital gains. Also, you may need to withdraw from your accounts. And then for some, part-time work. And part-time work can be because you're bored or because you have a financial issue. And if going back for 1 second, when I talked about that total return, so your total return from your investment is your interest, your dividends, and your capital gains. And so you can use those gains to help fund that retirement paycheck too, by taking some of those gains and withdrawing them. But you want to be careful. You want to try to set up a structure, which I'll talk about a little bit more later, that allows you to hopefully not buy high and sell low. So we want to try to put some things in to protect us. When we retire, we have kind of 2 types of expenses, and I go back to the accounting side of the world when I use these terms. There's the fixed expenses and there's variable expenses. Fixed expenses, we know what those are going to be every month. If we have a mortgage payment, we know what that is every month. If we have real estate taxes, we know what we're paying for our real estate taxes. If we're renting, we know what our rent is. If you have insurance, like homeowners or renters insurance, or your car insurance or car payments, those things are also all fixed. Then there's variable. Those would be maintenance on your house, your car, your food, your utilities, your phone, though some people might consider that fixed, but you can make some changes to it and change the amount of the fixed payment. Entertainment, travel, health and fitness. Now, to a certain extent, there's a piece of those, some of those expenses I mentioned that might be considered fixed, like, for example, utilities, right? We want to make sure that our house is comfortable. So maybe we can, instead of, we could set the temperature a little bit higher in the summer and a little bit cooler in the winter to lower that bill, but we can't go too far in either direction because we're just not going to be comfortable. It's nice to, in particular, if you can kind of match your fixed income with your fixed payment. So at least that part of it's a little bit more under control and a little bit more manageable. Also have to consider, what should your withdrawal strategy be? And there's lots of things here. Which account should I take money from first? Do I want to take it from my taxable accounts? Do I want to take it from my tax deferred accounts? And within tax deferred accounts, we have things like IRAs, we have Roth IRAs, we even have your health savings accounts. Which one do you want to take your money from first? Some people tell you to take it all from to save the Roth money for last, because it grows tax-free, it comes out tax-free. You could also think about taking pro rata, or just kind of figuring out what makes the most sense. And I'll talk more about the tax aspects as I go through this, but something that I often refer to is called bracket stuffing. And what do I mean by bracket stuffing? It's like looking at the tax table, looking at my income, and figuring out what level of tax am I comfortable paying, and how much more income can I take to fill that bracket. I've had conversations with some clients about that in the last few weeks. Like, for example, I have a client that has a large annuity that was inherited. And when you have that annuity, it's all ordinary income. But because of their situation, they had room in one of their tax brackets. And so we took $60,000 of that annuity this year, and we recognized it as income at a low rate. And that reduces the expenses associated with their investment, gives them some access to capital at a cheap amount. And what about income taxes during retirement? Believe it or not, when you retire, your tax bill can increase. You can owe taxes on things like your IRAs or 401ks, and IRAs can include inherited IRAs as well. When you have a Roth IRA, there's no tax on that. If it's used properly, your healthcare savings account, or HSA, that does not give rise to a tax liability either. You can also have taxes associated with a regular taxable brokerage account. You can pay taxes on the interest and dividends earned in that account, as well as any capital gains. The thing to remember too is look at the different types of tax structure that comes with a taxable brokerage account versus an IRA or a 401k. With the taxable brokerage account, under current law, your dividends and your capital gains are taxed at a lower rate. Your IRAs and 401ks, the money that you take out of those, is taxed the same as your ordinary tax rate, your highest marginal rate. And then Social Security and pension income. Social Security, you do get to exclude a little bit of your Social Security income, or you may be able to. Your pension, that's going to generally just be taxable income. There can be some amounts that are not. Your 1099 that you'll get at the end of the year, we'll discuss, we'll talk about that a little bit more, or identify those amounts. But those are all taxed at ordinary rates, which are higher than capital gains rates. If you're married and you have capital and your income is under $80,000, any capital gains that you recognize during the year that keep that income under $80,000, you pay no tax on those. So that's something that oftentimes, if you have like those gap years, you stop working and you don't have a lot of income, you haven't started Social Security yet, and you haven't started your IRAs yet, that can be a good opportunity to look and see, are there opportunities to recognize some 0% capital gains? Next thing is, how do you pay your taxes? When we work and we're employees, our taxes are generally withheld from our pay. When we stop working, relying on a retirement income, that doesn't apply anymore. Your required minimum distribution amounts or any other withdrawals that you take from your IRAs or 401ks, you pay tax on those. And how do you do that? Well, there's two different ways. You can use estimated payments, where you make payments every quarter. Those payments are due in April, June, September, and January, the 15th of each month. Or you can talk to the payer of those benefits and have them withhold. The benefit of withholding is that the way that the IRS looks at it, amounts that are withheld or considered to be withheld equally throughout the year, if your estimated payments are based upon when you pay them. And so you could actually not pay any taxes during the year if you wanted to until the fourth quarter. And if your benefits that you're getting from your RMDs are large enough, you could basically have them take as much as you need of that to equal your withholding, your estimated tax for the year, and not have to pay any penalties. Because if you don't pay enough in estimated payments, you can be subject to penalties. Then, are you comfortable with investing in its tax implications? I talked about before, we're switching from building up our assets to spending down our assets, right? And we have all these different types of tax accounts. Are you comfortable with how all that gets handled? Are you comfortable with the treatment of those different account types that I mentioned? Well, I talked about bracket stuffing, right? Do you have ability to recognize some income in a lower tax bracket? Then Roth conversions, and there's a lot of ways Roth conversions matter. For a lot of couples, when I do their financial plan, for a lot of clients, I talk about the potential to do Roth conversions when maybe it's when they stop working, if they're stopped working before 70 and they haven't taken Social Security yet, or even if they have gotten to where they start taking Social Security, but they haven't started to take their required minimum distributions yet, their income could be lower. Be a good time to consider taking some of your IRA money and converting it into a Roth. The benefits to that are multiple. There's several benefits. So one benefit is that, think about when we're married, we file a joint tax return. And while there still is some marriage penalty in the tax rates, you don't pay as much as a married couple as you would if you were single. Why does that matter? Well, typically one spouse passes before the other. And the normal progression is that the assets go first to the other spouse, and then they go to children and grandchildren and anybody else that you want to leave the money to. So that spouse is going to have the same income alone that you had as a couple. So if I've done some Roth conversions, I've reduced the size of the required minimum distributions I have to take. And that means that I hopefully have reduced the tax rate and the effect of going from a joint return to a single return. Another thing to think about is if you think about what happens after you're both gone, especially if you have money in IRAs, under the Secure Act, which was passed at the end of last year, you don't have to take money in an inherited IRA if you're not a spouse, or there's a couple other special conditions. If you don't fall under those conditions, you have 10 years to take that money from an inherited IRA into income. If it's in a Roth, you still have 10 years, but you don't have to worry about paying tax on it. And what can happen is it's called like a tax bomb, right? If you leave money to your kids and they're working and they're making money, and now they throw on a meaningful benefit from an IRA, well, that could jump up their tax rate, make them pay a lot more in taxes. If you're the beneficiary of an inherited IRA, there's a couple of things you can do too. One of them that I like is if you were not contributing the maximum to your retirement plan every year, think about increasing it to the maximum and pulling enough out of that IRA to replace what you're taking out, because it's going to end up being tax neutral, right? Because I'm going to get a bigger deduction for the additional amount going into my 401k, and then I'm going to have income that offsets it by taking some of that IRA money in now. And so that's one way, and then you can kind of look and see, is that enough to get you to where you need? But it's a way to at least offset some of the tax that you might have to pay if you have to take a distribution. Another thing to think about is, for example, I have a client who's planning to retire in 5 years. And so we've talked to, and her father passed away this year. So we've talked about the idea that she shouldn't take anything out of her inherited IRA for at least 5 years, because when she retires and her income falls, then it makes more sense to pull that money out because she'll pay less tax on it. For more on withdrawal strategies, I've also provided a link to a blog that I wrote on tax-savvy retirement withdrawal strategies. Something else to consider is a bucket strategy. And what do I mean by that? I've spoken a lot on behavioral investing, which is really how our behavior and finances, how they combine, right? Our emotions can get in the way of our investments. We want to avoid buying high. We want to avoid selling low. And so in that context, when there have been major market dislocations, and what happened in March of this year, where we had this really rapid recovery, is certainly the exception. Typically, the market has come back in, let's say, 18 to 24 months. So a lot of times when I have clients that are in that withdrawal stage, I think about, let's put enough in cash or cash equivalents, like things like savings accounts, money markets, short-term CDs, maybe some short-term bonds, to meet those needs that we might have over the next 12 to 24 months. I understand that your return is going to be hurt by that a little bit, because now I've got a bigger allocation to an asset that's not returning a lot. But on the other hand, what that does is it allows me to avoid selling low, because I've got that cash on hand. And then when asset prices recover, I can then sell some securities and replenish that cash. And I think at the end of the day, that opportunity cost that you take by having those assets allocated more conservatively protects you so that you don't lose as much. You know, a major market dislocation could be 20, 30, 40, 50%. If we look at the bear markets historically. Well, avoiding the impact of that loss would more than offset the loss of income that we have, or the loss of growth in our assets that we have, if we put that money and take it safely, invest it safely to meet our near-term needs. But also think about, like, what are your medium-term goals, what are your long-term goals, and what are your legacy goals? Because certainly if your goal is to leave something to your kids or your grandchildren, right, then those assets aren't really being invested for you. They're being invested for another generation, so they can be invested much more conservatively. So you want to be careful about getting too conservative with your entire portfolio as you age, because the other thing is, the more conservative we get, we look at history, that usually translates into the lowest returns, because the stock market has outperformed the bond market over the long haul. And if we're too heavily into bonds and cash, then that's going to increase the chance that we run into that longevity risk where we can potentially outlive our assets. Like I said, the whole purpose here is we're trying to help avoid selling in a prolonged bear market. You want to avoid selling low. So that's especially that first short-term bucket. That's really what we want to think about a lot there. Some additional things to think about. Are you considering everything? If you think you might have some missing pension assets from somebody you used to work for, you can go to PBGC, which is the Pension Benefit Guarantee Corp.gov, and see if you can find anything there. There's also missingmoney.com if you might have an old bank account that you can't find. Also, consider consolidating your accounts. It's all about simplification, right? If you have multiple IRAs, you don't want to have to worry, and 401ks, think about putting it all into one. Just makes it easier when it comes time to take your RMDs. Now, if you have multiple IRAs, you can take one required minimum distribution from any one of those accounts. A 401k, you have to take a distribution from each. So if you can combine those IRAs and 401ks into a rollover IRA, just makes life a little bit simpler. You don't have to take as many things out. It's also simpler to have one login instead of multiple logins for all these different accounts. Think about your home. Do you want to downsize and move into a smaller home where you lower your costs? Maybe you want to rent. If times become a little bit more difficult, can you do part-time work or consult? And also, can you turn your hobby into a money-making enterprise? I know I have a client that she has an interest in growing flowers. And so she's getting closer to retirement within the next couple of years, and she knows where she's going to live. And she's putting in a greenhouse, and she's investigating and looking into, raising and growing flowers. So now she's taking her hobby and she's turning it into something that helps give her a little bit of extra income during her retirement. That's it for the formal part of my presentation. I'm happy to take any questions that any of you might have at this point.
I have a question. Can you hear me?
Yes, I can.
You said something about combining accounts. I have an IRA, a SEP, and a KEO. Are any of those combinable?
When you stop, yes. So you can't combine your IRA with your SEP while you're still adding money to it, because the SEP has different rules to it.
Well, so I have a KEO, and that's what I put all of my money into now, because I think I can put 60-some thousand a year. But I'm not able to put money in an IRA and a SEP currently, because I'm totally funding my KEO.
Right.
So does that mean I could combine the SEP and IRA? I mean, I don't want to. I mean, they're fine where they are, but I'm just down the road, I probably would.
Yeah, you could. You just do a rollover. And so the easiest thing to do is do a direct rollover, because if you do a direct rollover, you don't have to worry about tax implications. So what it does is just the one account is just transferred directly into the other. And you can even do it in most cases where you can transfer the holdings that are in the account too. So all you're doing is just, it's like a paper transaction, right? You hold XYZ in account 1, you move it into account 2.
Got it. I have another question, and then I'll let Randy go or somebody else go. I can't hear you on Phil's screen. You need to turn your volume, your voice on.
You currently.
I do. I have a SEP with Wealthfront.
No, I have a SEP that would roll. Correct, but we're currently funding your 401k.
I know, my KEO. It's a KEO, but same. Yes, that's correct. Yep, I know that. So you talked about how, I think the biggest anxiety for everybody that, my friends that are in my age, is how much money do you need? That's the biggest question. Wow, what is there any formula or any rule of thumb you use to try to figure out, okay, what is the amount that you need to retire and not panic over your monthly income?
Yeah, that's a question that doesn't have an easy answer. Right?
I know it doesn't.
When I do a financial,
I'm asking it, Phil.
I know. So when I do a financial plan, that's designed to help inform that answer, right? Because we kind of look, I mean, in general, most people think they're going to spend a lot less when they retire. You often don't, right? Because some of your business expenses are substituted for personal expenses because you have more time. There are people, I mean, one rule of thumb a lot of people like to use, though it doesn't always work, is the 4% rule. So the 4% rule would say that if I had $1 million in retirement savings, that I could take $40,000 out a year, and that would allow my account to not run out. That's the one general rule of thumb, but I've seen some people that say that may or may not work, but that's a rule of thumb. But like beyond that, really a financial plan.
Right. Well, 4% of 100,000 is only 40,000 a year. Well, not even, that's 40%. So that's not much money to live on.
Well, but remember, if you've got Social Security on top of that, right? So Social Security might give you another, if you're close to the max, you're going to get, at present, you're going to get 40, I believe the maximum Social Security payment is a little less than $4,000 a month. And so you get like around 40 or so from Social Security. That's a piece.
Yeah.
And so if you add those two, so now you're at, 80-ish. If you have that $1 million in my example, that's why one of the primary reasons that the best thing you can do of all of these things is start early.
Right.
In the blog that I'm putting out tomorrow, one of the articles that I share talks about the difference between somebody that starts saving $500 a month for 30 years, and then compares that to somebody that started at $500 a month, and then every year they increased that by $20. So then it became $520, and then $540, and so on. And you added in that example, I think you added a little over $100,000 in savings by that increase, but the value of your portfolio went up by over $260,000.
Mm-hmm. Compounding is huge.
That's correct. I mean, and so all of us that have kids, that's something we should be beating into their heads like every day. The sooner you start, the better off you are.
Right. Yeah, I would like to send my son a chart of that. I guess I could Google it and it will come up.
And even like you know, like I have two of my kids that are one that's in college and one that's in high school. They're opening up Roth IRAs.
Yeah.
Even though the retirement's so far away, think about the fact they'll never, their income's low enough that they don't pay a lot of tax on it today. They'll never pay tax on it unless they change the law. They're not going to pay tax on it in the Roth account, and they're not going to pay tax on it when they pull it out. So that's like a lot of compounding and tax-free growth.
That's huge. Can I ask another question, or am I a total screen hog?
That's fun.
I told Randy beforehand I talk a lot on these balls. So in trying to establish income, I've heard mixed reviews about investing in dividend stocks to get income in that regard. What's your feeling on that? I mean, it is taxable income, but nonetheless, it is income without having to sell stock.
So personally, I'm a big fan of dividend stocks. And so one of the things that I've done, because interest rates are so low, you can't get much from that part of your portfolio. And I still think there's a diversification benefit that comes from having bonds in your portfolio. So I don't want to give that up. And I don't want to say, oh, well, let's just increase the allocation to stocks and dividend paying stocks to offset that. What I will do, though, is especially as we get closer to retirement, I'll try to tilt the portfolio a little bit more towards income producing stocks to make up for the fact that I'm not getting as much income from the bond side of the portfolio. But when I'm doing that, you want to be comfortable that either you're picking an ETF that you're comfortable with, or you're picking good, solid blue chip companies that you have reasonable expectations that that dividend won't be suspended or decrease.
Right.
You're hoping it grows. Like I like to think about the idea that like the biggest difference between a bond and dividend is if I put $1,000 into a bond that's paying me 4%, I know I'm going to get $40 a year. And at the end of the whatever, let's say it's a 30-year bond, I got $40 a year for 30 years. And I got my $1,000 back. That $1,000 is worth a lot less 30 years out. If I take that same $1,000 and I put it into a stock that today is paying 2%, and let's say that that dividend doubles every 10 years. So now on my $1,000 investment, I'm now getting 8%. And hopefully my investment is worth more than $1,000. So after that same period of time, my income grows and the value of my investment grows and I end up better off.
Right. It's good to know. I mean, I think dividend stocks are a great option to help fund retirement. I just am always interested in your opinion. Thank you.
You're very welcome.
Okay. Randy?
Well, Phil, I'm going to see if anybody else has questions. I have a couple, but I'm going to let other people chime in if they need it. I leave you.
No, you go ask your questions, Randy.
Go ahead, Randy.
All right, so Phil, so I can see once we stop making income, I can see managing our tax bracket, you know, on an annual basis, saying, okay, what do we take from here? What do we take from there in order to get us, you know, at a maximum, but not going into that next tax bracket. So what accounts can you manage that way?
So the easiest ones to manage are your IRAs and your 401ks, your Kias, all those tax deferred accounts, because you can manage how you take that into income. And another thing to think about too, there's other things that you can do that I didn't talk about, is when you get to 70 and a half, it's not even 72. 72 is when you have to start taking distributions from your retirement funds. But at 70 and a half, if you're charitably inclined, you can also, instead of having the money come from your bank account, you can take part of your required minimum distribution and contribute it directly to a charity. And then that income never gets into your tax return. So you avoid that. Another thing to think about is if I have in my brokerage account, I have my taxable brokerage account, if I have some securities that I have big gains on, I can donate appreciated securities. I get a tax deduction for the value of that security, the fair market value of that security, but I don't have to pay tax on the gain. So that it's not just, so, you know, I talked about the bracket stuffing from an income perspective, but there's also things that you can think about that you can do to more efficiently use your assets to do other things that help you, you know, like I said, taking a contribution from, if you're going to make $1,000 contribution, if I give appreciated stock instead of cash, well, now I don't have to replace that cash, right? I gave the appreciated stock, I didn't pay tax on the gain, and I got a deduction for that full value, and I still have that $1,000 available to me without paying tax. So it's also thinking about things like that too, because it's all about ways that you can be more efficient. But the primary account for bracket stuffing in general is going to be any tax deferred account, like a 401k, an IRA, or a KEO or SEP, those kind of accounts.
Well, you have to add your pension, your Social Security, and then the difference comes from one of those accounts to make sure you don't go over into the next bracket. Is that correct?
Yeah, I mean, so like typically what I do when I'm talking to people is I say in the fourth quarter,
yeah, exactly.
An idea what your income is for the year. That's a good time to visit the year and see what kind of room there is. Like I mentioned, the couple that we took the distribution from their annuity, we had a conversation right after Thanksgiving and decided that it made sense to take that $60,000 from their annuity and receive it this year because they were going to pay such a low amount of tax on it. And that's how much, we left a little bit of room, but not a lot over and above that.
Great. That's very helpful.
I'm glad. Any other questions from anybody?
Can you hear me?
Yes.
Hey, thanks. Under any circumstances, for someone that doesn't need life insurance, does a max funded indexed universal life policy make sense for retirement?
In my opinion, no. And there's two reasons that I'll talk about. So one is that when you buy an insurance policy and use it for investing, you're combining your investing with your insurance, and you're normally going to pay more, right? Because most of the investment options that you have under insurance policies are expensive, more than what you would pay for a portfolio. And then the cost of insurance becomes a little bit more too, because those policies are set up so that the person that writes the policy, they collect their premium, their commission, and then the insurance company wants to collect that. So that's part of it. Now, if you have a really large portfolio, then it can make a difference, right? Because I can get things out of my estate. But I think that was not a consideration in your question. The other thing is that a lot of those policies, from what I've seen on them, they're set to protect you to the downside, but they limit your upside. And so if I look at long term, the market has returned 8%. And percent includes the good years and the bad years, right? If you have that policy and it caps you at, let's say, 10% a year, well, when the market goes up 30%, you're not going to get that 30% gain, right? When it goes down, you're not going to have the loss. But if you look at it, the market returned 8% over the long haul, your return is going to end up being less than it would be if it had just been invested. I mean, that's every time I've looked at that, those policies are going to return less than the market because of the fact that the upside is capped.
Hey, thanks for that. That aligns with my understanding of the policy, what you said about the caps being limited and everything else you said. The one thing that I don't understand is the tax-free loans from the insurance policy. If that is ever a benefit to somebody, or if this is all just a gimmick for insurance company profits, if that makes sense.
It does. I mean, I tend to think of it as more a gimmick for insurance company profits, because again, you're really borrowing from yourself. And if you don't repay that money, well, then your benefit's going to be hit on the other end, right? I mean, I know I had a client that came to me with, she had worked with a broker, and the broker had her buy a cash value life policy to help fund her daughter's education. And he said, well, when your daughter starts school, you can borrow money from the policy. But if I borrow money from the policy, if I don't pay it back, my policy goes away. And because of the way the fee structure was, the policy was actually, they had a loss on the policy. It was like I forget what the numbers were, but I know the policy was worth less than what they had put into it. So just canceling the policy was a loss. So again, I tend to think that those, they sound really good. And you can get, it's meant to give you a way to get some money out without paying tax, but I just feel like the costs are too great.
Hey, appreciate it. Thank you.
You're very welcome. Anybody else?
You know, can you predict what's going to happen in 2021, Phil? It's been a crazy ride, and now it seems like we're consistently above a Dow of 30,000. And I know you're a big believer, and I am too. You still put a little money in the market every month, but I'll tell you, it's kind of scary right now because the world is kind of crazy to be having the stock market so high. And I don't have a lot of confidence to keep making those monthly deposits.
It is
The
hard.
stock market's been high since day one, and every 10 years it's higher.
Good
However,
comment,
someone says
Russell.
to you it's
Thank
too
you,
high,
Russell.
it was too high 5 years ago. It was too high 10 years ago. Keep on putting it in every month, every quarter. Yeah, every now and then you'll be putting in at a lower price, but you'll be buying more.
That's wisdom, right?
That's like the example I gave. And so the other part I'd say to that, you asked about a prediction. So I'll rely on an answer that I used to give when I was an oil and gas analyst. And forgive me if you heard me say this before, but I used to get calls from reporters and other people asking me for my outlook on oil prices. So I would say, look, my job, I'm paid to predict and forecast what the price of oil is going to be. So I'm going to give you a number. But there's also one thing that I can pretty much assure you. There's one number it's not going to be, and that's the number I'm about to give you. And I did that for 7 years, and I think one quarter I hit it on the nose, and that was just luck.
Right. But you're right. I mean, a little bit every month goes a long way. You get the highs, you get the lows, you get the flats.
Right.
But it's just hard right now because, oh my gosh.
It is hard. It
There's
is
just,
hard, but
yeah.
you just have to rely on the fact, as Russell said, if you look at longer periods, the market goes up. So you just say, I'm buying it. I'm getting, at some point, if it goes down, I'm confident, unless for Japan, it's coming back.
I mean, what you're
That's
looking
the
ahead
exception.
to is a lot of money on the sidelines that will be spent when people can start moving around. So you're going to get a bit of a sugar high probably sometime toward the end of 21 and into 22. But after that, we may have a quiet period. In addition to which, in almost every year, you get an intra-year pullback of 10, 15%. That's normal. 30 or 35, yeah, maybe every 5 or 10. But, when you're at 30,000, you can look back at 25. If your time horizon is 2 or 3 years, I'd say put it in the mattress. But if you're in reasonable health and you have a pretty good time horizon, stop worrying. Don't make yourself crazy. Trying to look ahead is like predicting the weather. You can't do it. You can predict the climate, however. You have a pretty good idea that in July it's going to be warm and in January it's going to be cold. That's the way you invest.
Thank you very much.
And I have one other question I see that came to the chat about hybrid life insurance. And I think that must be referring to the policy. You can get the hybrid policies that give you some long-term care coverage or life insurance. I've had some clients, I've looked at this with some clients. None of them have chosen to do it, but it is something you can at least consider doing because, if you don't need long-term care insurance, at least there's something that comes back at the end. But again, you just have to be careful because like when you do a plan, let's look and see what do we think our costs are going to be? And do we think that we have enough to cover those costs? And if you can, then I don't know that you need the insurance, but if it increases your comfort, I guess that's one way to think about, that's one type of policy to think about because you can get that hybrid that kind of protects you and protects your.
Yeah, that's not like going in through the back door. I mean, but some of us are allergic to insurance and I've been involved with it for years. But my rule of thumb is the primary beneficiary of most insurance policies, particularly life, is the commission being paid to the person who sold it.
That's right. That's the one that makes the money.
Says to me, I need life insurance. Say, learn the word term. and use a term insurance policy to cover specific needs. Do not think of a life insurance policy as a great investment. It is not. It is a vehicle that generates a substantial commission to the person who sold it.
He's right. That's who benefits. And you know, the old line is buy term and invest the rest.
Yeah, and you say that's the benefit. In fact, the beneficiary is the salesperson.
Yes.
Think about that one.
Hey, Phil, one more question, kind
Yes.
of not as strategic as the others, but with the pension payouts, I mean, you either choose to pay yourself until you die or continue to pay yourself and your spouse afterwards. Pretty big difference between those payouts on a monthly basis. How do you make a determination about that?
So when I do that, I mean, I have a spreadsheet that I use to help, and you look at kind of the joint life expectancy, what the return is, and you know, a lot of, and what the payout is, and determine, sometimes it may make sense to just roll it over and not take the pension at all and manage it yourself. But you have to kind of look at those different factors. What's your life expectancy? What's your health? What's your spouse's life expectancy and health? What's the, so then that gives you that joint life expectancy, and look and see, all right, well, what's the return that I'm getting? And does that make sense relative to what my other options are? Because you really have, the options that you have is you can take the pension, right? You can take the pension either singly or joint, or you can roll it over. You take that lump sum and roll it over. You don't really want to take that lump sum and just take it, because it's going to all be taxable at once. If you roll it over, then it becomes like your IRA asset, and there's a comfort level that comes with that for some people too, right? Knowing that you have that amount of income, though I know, like in my case, so when I started my career, I worked for Deloitte, and I had a pension. It wasn't huge. And when the last time I got an option to take a lump sum and roll it over, my wife asked me to do that because she was like, what if they're not there? Because that is the one risk that you have. I know that you have the PBGC that's supposed to back it, but there's still some risk. I mean, we've seen where companies have gone bankrupt, and then what happens, because, you know, most plans are underfunded. So you just want to think about what's your level of comfort.
All right. Maybe we talk about that offline.
Sure. All right, anybody else? If not, I'm going to wish everybody a happy Hanukkah for those that are celebrating the rest of that, a Merry Christmas and a Happy New Year. And I will be back again, I believe it's the 14th of January with my next session. Thanks, everybody.
Thank you, Phil. This was very,
Thank you,
very
Phil.
informative. We really appreciate your time.
Hey, thanks,
Thank you.
Phil.
You're welcome.
Take care. Happy holidays to you back.
Thank you.